Okay, let's dive right into this. Right now, there is this invisible structural mechanism quietly shifting global markets. And honestly, it is completely changing how we measure corporate success. If you're only paying attention to the traditional metrics, you might literally be missing the biggest financial transformation of our era. So, in this explainer, we're going to unpack exactly what this shift is, how it operates completely under the radar, and why the old ways of evaluating a business are, well, rapidly becoming obsolete.
Think about it. What truly makes a company valuable today? For decades, we thought we had the perfect ironclad mathematical equation for this. But that fundamental equation of what makes a company valuable, it's just changed. And it happened while the broader market was basically looking the other way. The reality we're facing is that the baseline definition of corporate worth is being completely rewritten from the ground up.
Which brings us to Section 1, the value equation shift. As you likely know, there is this massive valuation shift happening right under the broader market's nose. And we're not talking about a flashy new tech rollout or some highly publicized mega merger. No, this is a quiet, underlying structural change in exactly how international trade and corporate liabilities are calculated. And man, it is catching traditional investors completely off guard.
Let's move to Section 2, decoding the CBAM acronym.
Now, you're probably already familiar with the Carbon Border Adjustment Mechanism, or CBAM, and how it adjusts the cost of goods based on their emissions. But to really grasp this valuation shift, we've got to stop thinking of CBAM as just another dry piece of trade policy. Think of it more like a new tax on invisible borders. It means that the carbon footprint of a product now carries a very real, very tangible financial weight the absolute second it crosses international lines.
Let's quickly walk through the logical sequence of how this actually alters a company's bottom line. Step 1, carbon emissions are tracked. The invisible suddenly becomes visible and, most importantly, measurable. Step 2, a border adjustment is applied. This means a hard financial cost is directly attached to those tracked emissions the moment goods are imported. And finally, Step 3, the company's valuation is adjusted. Listen, if your supply chain is carbon heavy, your cost of doing business just spiked. It's literally the equivalent of waking up to find your shipping costs tripled overnight. This immediately compresses your profit margins and ultimately tanks the overall value of your company. It is a direct, undeniable chain reaction. So, let's look back at Section 3, the old valuation rules. If you took a finance class anytime in the last 50 years, well, this is your bread and butter, right? Revenue, profit margins, operating costs, and capital expenditure. These are the familiar, traditional metrics that historically determined corporate success. But take a close look at what is glaringly absent here. The environment. Historically, a massive industrial polluter and a clean tech company with the exact same revenue and operating costs were valued exactly the same. Kind of crazy, right? There was absolutely zero accounting for the actual environmental cost of production. And that brings us to Section 4, the new paradigm revealed. This right here is the exact moment the paradigm shifts. Under the old, traditional, carbon-blind paradigm, emissions were completely ignored to basically manufacture profit. But step into the new CBAM, carbon-adjusted reality, and you can no longer hide your emissions. The whole era of artificially inflating value by ignoring your carbon footprint, yeah, that's over. This new carbon-adjusted reality forces companies to finally account for their environmental impact in actual hard dollars and cents.
Let's look at what this means in Section 5, the bottom line impact. So, the absolutely crucial point here is how this grand macroeconomic theory translates into a tangible financial reality for everyday businesses. It creates a literal new line item on the balance sheet. Basically, CBAM manufactures a brand new financial liability for high-emission companies and, conversely, a massive competitive advantage for low-emission ones. It forces a complete recalculation of worth across the board. If you're an investor or a CEO, you suddenly have this massive new expense column that could entirely wipe out your projected profits if you just aren't prepared for it. I really want to highlight this quote from Genecapsule, which serves as the core source material for our explainer today. CBAM is quietly redefining what makes a company valuable. I mean, that perfectly encapsulates this entire shift. This isn't just some minor regulatory update that only the compliance lawyers need to worry about. No way, it is a total, ground-up redefinition of corporate value. The very DNA of what makes a business profitable on the global stage has been fundamentally rewritten. Which leaves us with this final, pretty provocative thought. Will traditional valuations even survive this new carbon-adjusted paradigm? As carbon liability is permanently priced into the market, every single business you invest in or even work for has to answer to this.
The rules of the game have completely changed. The only question left is, are you using the right metrics to keep score?